Welcome back, everyone, to MorningLine. We are talking this morning investment, stock market volatility. Hank Parrott's with us, of course, host of the Retirement Report, investment counselor, and it's good to have him on. Author as well. This is It, Is It Not? 7 Steps to Financial Freedom. Hank Parrott. There's all kinds of great information.
In fact, you know, if you want to, anybody that's watching today, if you want to call, if you give my office a call, there'll be someone there around 9 o'clock, and I'll put it out to the first 10 callers. We'll send you out a copy of my book, 7 Steps to Financial Freedom and Retirement.
Great. We'll get your phone number up there and the like. That's very nice of you to do that. So, just wanted to pick up where we kind of left off. Right now, some people concerned about their retirement accounts.
Right.
The bottom line is, as you said, I really think, is not only allocation, but time. Now, there's going to be people out there right now that are maybe just on the cusp of saying time to retire.
Right.
What should they be doing right now?
Well, one of the things that you've got to look at is what you've got for income. All right, income is the biggest thing. It's not about investing for growth. All right, you need growth to stay ahead of taxes and inflation, of course. But if you've got a good income plan in place, it's going to take care of your standard of living, your quality of life, pay the bills every month. You know, maintain again what you want, whatever that income need might be. So we look at your, let's say you're retired. We're looking at your Social Security. If you have a pension, any other income sources like rental income or whatever it might be, then we say how much you're going to need from your retirement accounts and at what point, or from your nest egg, if you will. And then we're going to set up an income plan. So we may put that in 5-year type increments. We might say, okay, over the next 5 years, we're going to set up this account, very low volatile account. We may use annuities, and this is another one that you need to understand annuities, and this is extremely important. It goes in with the market. Variable annuities is an example. There are about 1,000 different annuity products out there. Variable annuities have sub-accounts which are like mutual funds, which means they can go up and down just the same way the market does. And here's the bad news. They have excess fees in them, all right, that you're paying as well. So you may be paying 3 to 5% per year in fees. Now imagine you got to overcome that to get any kind of return. Very difficult, okay? So I basically do not recommend variable annuities. So that takes about over 700 of the 1,000 products off of your list right off. Now you got a few hundred left. You got immediate annuities, which are strictly for income. You've got fixed annuities, which work kind of like CDs. You get a set amount of interest for a specified period of time, and then you're done. And then you got fixed index annuities, which will have some kind of a index to a market index, such as an S&P or a Barclays aggregate bond or JP Morgan Mosaic. There are a number of different ones out there. You want to look at that. You want to look, ideally, you're going to narrow it down. There's about 25, maybe 30 products out there that are uncapped. They're not going to cap out your rates, and that's another thing you want to avoid. If you have caps, it's going to reduce your returns to about 2.5 to 3%. That's not going to be enough. You want uncapped, but here's the nice thing with those. You can't lose any money in them, all right? You can set a floor that says the worst I'm going to get is 0, and the best is some participation rate in a particular index. Now, what's the other thing you get with annuities? Think of this, 403B, for those that have them. What is a 403B? This is a retirement plan for teachers and nonprofits typically. Okay. What are they? They're annuities.
And what is an annuity, if you can? The definition of that is?
You know, it's like pensions are a type of an annuity. Okay. Basically, it is a stream of payments guaranteed. There are different versions, but we're going to stick with the most traditional, which is a stream of payments guaranteed for life, possibly for 2 lives for a couple.
Gotcha.
So basically, if I invest in an annuity, one of the things I may be looking at, income in the future. So I can say 5 years from now I want to kick in that income, or 10 years from now I want to kick in that income. An immediate annuity, 1 month from now I may want to kick in that income. And what that does, though, is it's going to take that, what am I concerned about when I'm investing in the market, and what's the biggest fear that people have? I'm going to run out of money. Yeah. Right? My portfolio is going to drop. I'm going to run out of money. That's why this volatility freaks people out. That's one of the reasons. I'm losing money, man. Am I going to get it back? Right. If I'm in retirement, I'm especially scared about this. Yes. But if I can get an income stream that says my standard living quality of life is set for life, am I going to be worrying as much about my investment portfolio?
So the annuity can be insulated from these crazy market swings?
Absolutely. Absolutely. In fact, it can take advantage of them in many instances.
Is it true that, I thought I saw a number, not only, or as many as 52% of Americans are in the market, but maybe half of all Americans are not. I think we know so many Americans don't save money the way they can or should, that they don't have investments or any plan for retirement.
Well, let's put it this way. I can tell you this stat that might play into that one a little bit.
I was just curious about that.
45% of Americans have exactly 0 saved for retirement.
They're living
guess what?
day to day. Yeah.
So there's 45% that aren't invested.
So that's 45% that are maybe
no
banking
savings.
on Social Security?
That's all they got to bank on. They have no money.
Okay, sometimes maybe they're just in a situation where they can't help it. They just can't afford to put it away. Other people want to live for the moment, and they're going to pay for it later.
This is congressional testimony. I mean, 45%. According to EB, the Employment Benefit Research Institute, 22% of workers feel very confident. Only 1 in 5 feel confident about their retirement. All right, this has a lot to do with not saving enough, not understanding how to invest, and what they're, worrying about things like this. Most of the people that panic at times like this are ones that really don't understand how they're investing, and this is why it's so important. It's okay, they're trusting. So there's going to be a lot of investment advisors probably yesterday that's phone was ringing off the hook. We don't get calls. We said when we put a plan together, it's about here's the needed rate of return to attain all your financial goals. Here's the retirement income part so that you're going to have all the income you need to maintain your standard of living. Here's the needed rate of return on the rest of our investments to stay ahead of inflation and taxes. And guess what? We're going to be able to minimize risk and volatility in doing so. So again, when you've got that peace of mind, you're much more able to just relax in these kind of times.
And that's important. A nice thing to have right now. Let's get back to some more phone calls. Let's go to Sandy. Sandy, good morning.
Good morning.
Hi, Sandy. How can we help you?
Yes, I'm just now turning you guys on, so you probably answered what I'm asking. But I got some mutual funds. When I bought the mutual funds, I just bought a lot of them, and I know some of them are doing some of the same thing, have some of the same products in it, because I bought a lot of from a mutual fund place. I bought just a lot of things that got the same things in them. But I'm going to get a pension, two pensions really, from the state and from Metro next year.
Right.
So I don't know. I want to know. Try to find out what to do with those when I do get those. And because I'm retired now, I mean, I'm not working now. Really, I need money now. But I wanted to know, do I change or let go some of those things that's overlapping with the same things in them?
Right. When you've got a portfolio, and this is very typical that we see this when someone has a bunch of mutual funds, but within those mutual funds they own many of the same companies. So in essence, there's a lot of those funds you probably don't need if they're just duplicating the effort. It looks diversified when in reality it's not. And the other problem that can mean, that means extra volatility, because when the market drops, they're all dropping at the same time. So what you need are asset categories. For instance, usually one of the things we typically see, now not always, yesterday is an example, 08 was an example, when large companies are up, typically small companies not so much, and vice versa. Now yesterday everything got hit. Internationals, domestic, small cap, large cap. But that's one of the mixes you'd like to have, is small companies and large companies together. An example would be the S&P 500 index and the Russell 2000 index. Okay, there's your 2,000 small companies and 500 large companies. That would be a good blend in a portfolio as an example. If you've got more and you can get into institutional funds where you can really get an even better asset allocation than that, then you can get into some micros and some other things that'll help your returns and yet still keep your volatility down. The next thing you want is that international part, and it's the same when you're looking at your internationals. You want to have some large companies and some small companies. If you don't understand these, you really need to get with an advisor that understands this part of it. Okay, again, one of the things I talk about how the smart money invests, there is a science to investing. Dr. Eugene Fama won the Nobel Prize in 2013 for his equity research. He developed a model that works. All right, it's been back tested over the history of the stock market, so we see how it does over different periods. And we have, even with the portfolios actually being in existence now, we've even got real world returns going back like 20 years. So this is things that you want to look at and find out. If you don't understand these things, or if you're not sure if your portfolio works in this way, this would be a great time to get with someone that does, that can help you with that.
Well, Mark seemed like someone that had it all together, and I think Sandy certainly is engaged engaged, but a lot of people like myself depend on folks just like you. If you would, just real briefly, maybe just from your own experience, just for the average individual out there thinking, yeah, or perhaps we've got, Sandy thinking, well, yeah, I think I'd like to get an investment counselor. Now, she's on a fixed income right now. She's about to get her pension. She doesn't have a ton of money, but she wants to invest. How does someone go about hiring someone like you, and how are the pay scales or the fees figured in? I mean, she's not a millionaire that's looking to invest in huge things. So how do people like yourself deal with folks like that?
Well, one of the things that it's a type of advisor too. So if you're looking at a typical let's say broker, a registered rep in a broker-dealer system, you may be looking at retail funds. You may be paying a sales load. This could be 5.75. You can, up front. So if you put $100,000 in, you're going to pay them over $5,000 up front in a sales load. Then you're going to have fees built within that, and those fees are going to take another probably $2,000 to $3,000 on that $100,000 investment every year. Even when the market, if you lose money, guess what? It's like an attorney. Win, lose, or draw, they get paid, right? So this is one of the things you need to understand: costs in your portfolio, which is where if you get into indexing or institutional funds, there are no sales loads. Okay, there are no excessive fees that are built into it. There's not a lot of trading costs because they don't change much. So reducing your costs down, now you're going to pay that advisor a fee, and the fees can vary according to the advisor. Okay, in my practice, it's 75 basis points, which is about 3/4% a year on those monies we have under management, meaning in portfolios. Some it's 2 to 3 times that amount. Okay, I think there's one of the national names, Ken Fisher out there, registered investment advisor, and if I remember right, last time I looked, he was over 2% per year on that. So that's another thing you want to consider: is what are my costs in this. There are also those that will do it on a fee basis. I have some clients that come in and they just want me to do a plan for them, and depending on the complexity of the plan, it might range from $500 to $5,000. It depends on how many moving parts and basically how many hours I'm going to have to spend with that client.
Let's get back to the phone lines. We'll go next to Joan. Joan, good morning.
Good morning.
Hey, Joan.
Hi. I'm a retired mail carrier on disability. I have multiple sclerosis. But my husband and I have bought rental properties, and so far we're doing pretty good. I've got 4.
Right.
And I'm worried about long-term care, and I don't have long-term care insurance. And I talked to my lawyer about we should maybe do an LLC, so all those properties are pretty much protected, I think, from huge bills.
Right.
What can you tell me about that?
This again, it would be an attorney question. I will say though, when it comes to long-term care, that strategy is one about insulating and for risk purposes. And there are a number of different vehicles you can do. Corporations are one. You've got to be extremely careful on how you run your business so that corporate veil can't be pierced and those assets put at risk. There are some other ways that you can put even more using irrevocable trusts, but each of these have downsides as well. All right, limited partnerships are another. But you'd want to seek good legal. What I would look to here, by the way, is I would want to sit down with the attorney and my financial advisor together. All right, that team approach, if you will, and it wouldn't hurt to have your tax person in that conversation too, to see what the tax consequences could potentially be on that. So you want to put it all together in a plan. So one is you're talking asset protection. That's important, but one way you can also do asset protection, I think in terms of liability, not a bad idea to try to insulate those. When you have rental properties, if someone gets hurt on the property, it also helps insulate your personal assets from that standpoint. But here's another thing. Do you have an umbrella liability policy? All right, these are very inexpensive. You're talking about for hundreds of dollars, a few $100s a year, you can get probably like a $2 million, maybe $3 million liability policy, and that might help a lot with regard to some of that asset protection. If you're talking about long-term care needs specifically, I don't think the LLC, if you're going to be an owner of that corporation, you're going to then have That's not going to insulate if you're talking about Medicaid type planning, for instance. It won't benefit you there. That's where you need. Now there are other ways, by the way, even if you're not, if you mentioned MS, so if you're not medically qualified for traditional long-term care policies, there are certain life policies and annuity policies where you won't have to go through medical underwriting, and yet you can still pick up some long-term care protection.
Take a break on that note. When we come back, we're going to take more phone calls. Taylor and others, if you're on hold, it always gets busy as the show rolls around. People waking up and joining us. And stick around, too, because we will give you the phone number on how to call. You can contact Hank's office and get a copy of his book, which has a lot of great information in it. We'll take a break and be back in our final segment right after this.